Hello, I'm David Cassidy with the market summary for the week ending Friday the 12th of February. Well, thankfully, the brouhaha about an imminent return of inflation and with it tighter monetary policy via higher interest rates didn't last very long. As we've been saying ad nauseum in our market summaries, with the exception of the pass-through of a distorted oil price, global inflationary pressures remain subdued, and as such, higher interest rates remain many years away. And thanks to last week's US CPI inflation data, coupled with comments from the Fed Chair Jay Powell, it finally became evident to the financial markets that inflation is not actually manifesting. Not only was the headline CPI inflation unchanged at 1.4% in January, but the core US CPI inflation rate, which excludes volatile items such as food and energy, and as a consequence we believe gives a better guide to where headline inflation itself is heading, actually fell to 1.4% from 1.6%. Now, this clearly highlights that higher oil prices, for example, US petrol prices rose over 77% in January and over 5% in December. They're currently being offset by the continuing price declines in other areas, hence why we believe that the Fed will look through any above target inflation in the coming months as last year's oil price slump works its way through the year-on-year inflation calculations. Furthermore, Jay Powell reminded markets that the Fed has a dual mandate, inflation and employment, and the Fed chair said he was very focused on rebuilding US employment, which will require supportive monetary policy for the foreseeable future, given that the US with 6.3% unemployment is very far from a strong labour market. And as we've previously stated, the US didn't have an inflation rate issue before the coronavirus outbreak when unemployment was just 3.5%. Interestingly, this labour market weakness was evidenced last Thursday in the jobless claims data. While both initial and continuing claims were lower than the previous week's data, which is a positive, this was predominantly due to the data that was being revised upwards, which is a negative. In the UK, the big news was Friday's GDP data. Thankfully, as we forecast, in our weekly summary back on the 15th of January, the UK did avoid a double dip recession. In fact, to the surprise of major economists, the UK economy expanded by 1% during the final quarter of 2020, having grown by 1.2% in December. So while this shows that the economy has adapted well to the coronavirus lockdowns, unfortunately, the stricter lockdown restrictions introduced at the end of December will mean that this current quarter we are in will see the UK economy contract. However, given the success of the UK's vaccination programme and the prospect that restrictions will be slowly eased, economic growth should pick up sharply in quarters 2 and 3. Looking ahead, this week, US markets are closed today. Monday, it's President's Day, while the 7 days of the public holidays for the Chinese New Year run until Wednesday, the 17th of February. This week's big data events that we'll be analysing include UK CPI inflation, US and UK retail sales, US, UK and Eurozone PMI, Eurozone and Japanese quarter 4 GDP, minutes from the last Fed monetary policy meeting, US housing, the US Empire State Manufacturing Index, and the weekly US jobless claims. All in all, a busy week.